Let's bring in Feroze Azeez now, Deputy CEO, Anand Rathi Wealth, to talk more about this. Feroze, let's talk China equities and your outlook. Sentiment has been pretty weak over the past few weeks now.
Yes, absolutely. The valuations have come into the fair zone, about 12.1 PE. I think there is fair degree of pessimism on the real estate sector, but there is some green shoots of its recovery. Point one, the rate cut is definitely helping from the central bank. Point is, I think it's showing signs of bottoming out, and there seems to be some degree of outperformance vis-a-vis the rest of the emerging markets in the next 3-4 months, very well expected from the Chinese market.
On the other hand, we're seeing Indian equities getting a boost, especially because of the state elections yesterday, won by the central government party. Let's talk a forecast for where, how the Indian equities could go, as well as some of the near-term risk and opportunities.
Yes. So if you look at Indian equities, the macroeconomic variables are stacking up beautifully. If you look at GDP, GST collections, which is the indirect tax collection. If you look at the IIP numbers, the fiscal deficit usage is just 45% so far in the first 7 months. So far, there's if you look at the average globe for the last 20 years, it's 73%. So fiscal prudence, GDP, GST collections, IIP data flows have been very, very robust. If you look at December, we've seen about $1 billion from the FIIs. We've seen 1.8 from the domestic institutions. So looking at this kind of conducive environment, and also the earnings growth on Nifty being at 944 for this year and 1,076 for the subsequent year, FY25, I personally think that equities in India have delivered are expected to deliver at least about 14-15% on Nifty, and the broader market has outperformed 20%. And FIIs seem to be participating in the India story, using the smaller, broader market, which is a huge change over the last 3-4 years. 4 years back, FIIs wouldn't step into the smaller stocks. Now, if you look at the MSCI Global Small Cap India Index, has about 190 stocks more than the Indian domestic small cap index. Those 190 stocks have got a lot of FII inflow, which completely proves the hypothesis that FIIs are not shying away from participating in the broader market. And if the next year, general elections, if governance continues, the kind of money sitting on the sidelines to participate in India is enormous, because inflation and interest rates are at normal levels or at 10-year averages for India, whereas the globe is struggling with these same two variables.
Interesting, and this will definitely be something to watch. At the same time, we're also closely watching gold. Gold continues to shine bright. Do you expect those elevated prices to continue? And would you say it is a good time to join the gold rush?
Yes, from a short-term standpoint, definitely I would agree. But if you look at the long-term gold prices, we have to decipher where the long-term demand comes from. India has been one of the largest importers of gold for the last couple of decades. And India is what India's strategy has been is to not spend its dollars in the foreign exchange reserve to buy gold. And they're converting the domestic gold. India holds the largest amount of gold as Indian households do. The central government brought in a scheme in 2015 to convert physical gold into paper gold, sovereign gold bonds, which I think has gone through a huge paradigm shift of absorbing all the gold import need. And that's what is going to impact the gold prices in the long term globally in dollar terms. That's why you see, of course, the gold prices are upwards of $2,000 an ounce, but I think long-term trajectory can't be very, very positive unless the largest import of golds are going to be importing gold. And India is surely slowing down its imports because of the conversion of the tons and thousands of tons of gold in Indian households into sovereign gold bonds. And government has given SOPs in terms of interest in those bonds and also tax-free status to them if held to maturity. This is a huge impact on gold prices over the next 10 years globally as well.
Where should investors be putting their money then? And what is their investment strategy here?
I personally think India is definitely one of the emerging markets which is expected to do well because the earnings growths are stupendous. If you look at the last 4 years, the earning growth has been great. That's point one. We are expecting another 12-13% growth, especially in the top stocks. If you look at the small stocks, the earnings growth of 20-25% is also possible if you cherry pick. So point one, in emerging markets is where the growth remains. And India is definitely one place where opportunities of spotting businesses which can grow at 20-25% is not so difficult in rupee terms. If you adjust for the dollar appreciation of 3-4%, still finding businesses of growth of 5-7 years of 15 to 17% exists. That's point two. Point three, I personally think that if one were to invest in the broader markets of India, the domestic flows, there's a shift of capital from debt in India. India has 670 lakh crores in Indian rupees in Indian households, and there seems to be a huge paradigm shift from debt to equity that will re-rate Indian equities dramatically. So, to answer your pointed question, I would be very bullish India and especially emerging markets, in particularly India.
All right, Feroze, appreciate your time and your insights this morning. Feroze Azeez, the Deputy CEO, Anand Rathi Wealth.